Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello and welcome to LiveSquawk's Market Talk Weekly Review. This is where we try and break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead, and we'll try and give you a heads up to what you should be looking out for. I say we because every week I'll be joined by market experts in their field. This episode, I will be joined by regular contributor and long-time trader, friend of the show, Ryan Littlestone of Forex Analytics, and Michael Brown, market analyst at Pepperstone, spread betting, CFD and Forex trading broker. The pair are otherwise known as Satan Greavesy of the financial market analytics. So welcome to you both.
Good afternoon, mate. It's a lot better than the double act you gave us last time. So I'll take that.
Bracket. Yeah, I'll take that.
Yeah, only reason I didn't use that picture is because it was licensed. You got away with one there.
I thought you were just being nice to us, but never mind.
No, you got away with one there. Right. So this week has been relatively quiet. I mean, there has been stuff going on, but next week we'll look at that in a minute. But there is quite a lot out next week, so you can probably drift through the week that was fairly quickly. I want to start with obviously the key points: US inflation, and then that labour data report that we saw at the start of the week that really set the scene. I'll start with Mike. What are your views, having seen both that labour report and the US inflation? Do you have any sort of take on what you've seen this week on that respect?
Yeah, I mean, I think the claims data was surprisingly more important than the inflation metrics, primarily because CPI was as near as makes no difference, bang in line with expectations at 2.9% on the year at the headline level and at 3.1% on the core metric. But then, of course, you had the claims number coming in at 260,000, which is the highest level since the back end of 2021. And of course, when you've just had in the same week a big downward revision to the benchmark payrolls number, 900,000 there. The week before, last Friday, of course, you had the pretty dismal August jobs report with unemployment and underemployment rising to cycle highs. It all just kind of adds to that market narrative around the US labour market continuing to lose momentum. Of course, cements the case for a 25 basis point cut from the Fed next week. Although I would just caution, I do think that the jobless claims numbers, maybe it's a little bit of an overreaction to that. A lot of or practically all of the increase came as a result of a big spike in jobless claims in Texas. There were some well-publicized layoffs there. Elsewhere, claims were relatively steady week on week. And you've also got Labor Day, which may have skewed things as well. So I don't want to completely write off the US labour market just yet. But nonetheless, the data is pointing to things continuing to stall on that front.
Yeah, well, like you say, though, those anomalies that did take part. But I mean, the trend has been the trend, and the trend in the labour market has been softer. So, it was going to take a bit of a shocker to really change views. Is that your thinking, Ryan, as well?
Yeah, I mean, 263, it's a high one, but we've been running between 200 and 300 for God knows how long, and it hasn't really budged. Continuous claims still sitting in that sort of low 1.9 millions. That didn't move either. So yeah, it's a weekly number. You can't get upset over one weekly number. I agree with Michael. When the market initially sees something like that in the focus of the jobs market as it is, then it's going to react. But unless we're trending over 400,000 a week and well above 2 million continued claims, there's nothing to write home about. And for the rest, yeah, we all knew it was going to be, these last 2 weeks were going to be big in terms of what it means for the Fed next week. This is all the data up to now has just been part one of the puzzle, i.e. what the market thinks the Fed's going to do. Next week, we find out what the Fed is going to do. And I think that's going to be the next decent market pricing that we get to happen, because as I've been saying, it's next week's going to be setting out more about what 2026 is going to do than the rest of the year. We know The Fed thought they're going to get 2 cuts this year. The market's happy with that. Might get 3 cuts this year. The market's now putting a sort of soft landing number at 3% for 2026. So that's roughly, if we get 3 cuts this year, that's roughly another 62, 3 cuts next year. Is the Fed going to agree to that? Are they going to be more dovish, or are they going to be less dovish? And that's why it's all hot on next week, I think.
Yeah, I mean, we'll come on to the FOMC and the rate decision. I'll have a quick look at that shortly. I want to look at the ECB rate decision now, and there's not a lot to see from this. But we'll start. Ryan, what were your views on yesterday and what Lagarde was talking about?
Oh, well, did she talk about something? I think I slept through most of it. Yeah, it was very low expectations of anything going into this one. The forecast, some small marginal changes that didn't mean a thing. The main take I took from that is that they've reduced or removed the higher risk aspect. In their June forecasts, they had 2 alternative scenarios for their forecasts, one mild, one severe, to do with all Trump and trade and everything. Those came out. Lagarde mentioned that as well, that the risks of that sort of stuff has reduced. Long story short, they believe they're in a good place with rates. They think and believe they're in a good place with inflation. The victory laps have started. The market's coming around to that aspect as well, all but a few ruling out potential cuts for the rest of the year. So it's there for them to lose now. They've set their stall out. They're happy with everything. The question is going to be, can they stay there?
Well, we had the sources stories. There were 2 sources stories, I believe, yesterday. One suggested that we shouldn't count our chickens about further rate cuts. The other one saying they're not going to move. So, for what they're worth, it was just, oh, brilliant, thank you. There's nothing they could do to try and animate.
Takes 2 to make a market, mate. Takes 2 to make a market.
It does. Mike, anything to add to what Ryan just said?
No, not really. I mean, the most exciting thing that happened to me during the ECB yesterday was the fire alarm going off in the office during the press conference.
Thank God you said that.
It was just quite lucky, really. I mean, I think really just kind of confirming what we already knew, that they believe that the easing cycle is done and dusted, and they're going to sit at 2% probably for the next 12, 18 months or so. Obviously, they're not going to pre-commit to that, and they're going to leave a little bit of optionality around easing further if the outlook worsens or if they start to project a longer term undershoot of that inflation aim. But I think as Ryan alluded to, it's almost a case of, job done. We're happy with where things are, and if everything evolves as expected, then the ECB are probably going to be on the sidelines for the foreseeable. And given that Ryan and I have got a lunch riding on that, I certainly hope they are.
One thing I will add to that quickly, and it's been evident again today from all the I won't call them the rats let out the shit, but after the blackout, they've all been rushing out, the ECB members, to give their comments. There's been a fair few comments about the exchange rate, which is something De Guindos has marked down prior meetings, that big psychological 120 level. Lagarde mentioned it, a couple of others mentioned it, that if the euro continues to strengthen, it is going to add a downward pressure to inflation. So that's probably something else to keep an eye on over the weeks ahead.
Yeah, well, something you mentioned yesterday. Sorry, go on.
Oh, sorry, Harry. I was going to say, De Guindos was talking about north of 120 before, wasn't it?
Yeah. So,
okay.
Market loves a target.
Well, yes. Just quick, I just want to touch on this because I just want to get your views, as market participants there. This Russia's Polish incursion and market-related ramifications, if any, it says here. Do you see anything from a market perspective that would get you worried or make you change your positioning or just start to hedge things a little bit on this front? Are you seeing anything that would suggest that, or?
No, absolutely not, to be completely honest with you. I think it was... I'm not a geopolitical expert. I'm not sure anyone is these days, to be honest with you, given how quickly things change. It doesn't feel like it was accidental. One drone, potentially multiple drones, that feels deliberate. Was it Russia sort of trying to poke the bear and test how Poland and NATO would respond? Probably. But really, I don't think it changes the calculus especially much. These geopolitical risks are sort of bubbling away, but they're not really something that the market has been especially focused on for a number of months, if not years now. And I think that's probably going to remain the case. I certainly don't think it's leading to a potential for broader escalation. I think the response has been relatively diplomatic and relatively contained.
Yeah, fair enough. Ryan, would you agree?
Yes and no. Russia's done this before. They do it quite regularly, actually. They've done this before where they've flown stuff sort of over Polish airspace, sort of curved it round Belarus, and just to, as you say, just to prod the beast. Obviously, this is the first time that a NATO country's had to shoot stuff down when that's happened. Before, it's all been about shouting and screaming. So I think, and as we know, we're always scrambling jets over here because Russian bombers are flying in our airspace and all that sort of stuff. So we know
it's not that unusual, is it?
Yeah, I think the escalation happens if he does something silly like that and something actually lands in Poland that hasn't been shot down, goes astray, goes off target. Then I think that becomes a bigger problem because obviously there has to be a reaction to that. And there will be a much bigger reaction to that. But I think that's low risk. He's probably going to hold off doing that sort of thing for a while after this move. But he's going to go prodding and prodding and prodding everyone, Trump and the West, while he's still up to his fun and games over there.
He is getting bolder. You can say that about all this. So it feels like he's getting bolder with his actions, him being Putin.
It's got to come to a head, hasn't it? Because Trump's given him deadlines. He's been pushing and pushing, had meetings, all gone well, but there's been no result. And Putin knows that, and he's either doing all this just to delay time while he takes more territory. The real risk is probably Trump. How long he's going to continue to give? How long he's going to give Putin before he does do something harsh? Sanctions aren't going to cut it. Are we going to see boots on the ground? Who knows? It's going to come to a head, though.
Yeah, well, let's hope.
Well, that's nice and cheerful, mate. Thanks for that on a Friday.
Not just
afternoon.
For the weekend.
And just quickly sticking with politics, we got the French situation that's happened. That's calmed down to a degree. We've got a rating tonight from Fitch. We're not expecting them to change the rating on France, but potentially that's cat amongst the pigeons going into a weekend. Really, would you play it safe over the weekend in terms of the Fitch rating after markets tonight? Again, Ryan.
Would it be a surprise if they did actually cut the ratings? I mean,
I don't think so.
It's a complete mess over there. Again, going back to the ECB, Villeroy this morning saying that maybe they're not done with cuts, which is, of course, easy to say when your economy's doing as crap as France is and your inflation is 1.5 below target, or the ECB target. It's a mess. The fact that they're being propped up by the likes of Spain these days is telling. Is it something that's going to deteriorate significantly? I think if this PM can't get a budget sorted this time, then I think the market might start to take a bit more notice, because it's going to be, come on, guys, you've had 2 PMs, you still can't get a budget done. But on the flip side, there's merits to being part of a collective that's ready to bail you out if you do have problems.
The second largest economy. It matters on that front.
I think the other thing, just on the ratings review, just to bear in mind, I would say the risk of a downgrade has probably diminished given that the new PM was appointed so swiftly. But the reason why this is important is because Fitch have currently got France at AA- on a negative outlook. If they were to downgrade them, that means that one of the agencies has then stripped France of its high grade rating, which could lead to a little bit of forced selling on its own. If a second agency were to then do the same thing, Moody's or S&P, then that is going to lead to some forced selling of OATs, because those portfolios that only hold high grade government bonds will not be able to hold French debt anymore. So that's a potential risk to keep on the back of your mind as well.
Yeah, thank God for the UK bond market being so stable.
Well, Rachel Reed's about the only person who's benefited from the US labour market softening. So,
fair point. Okay, on that note, then let's look at the week. Let's look at the week ahead and see what we have coming up. Obviously, we mentioned it earlier in the show. FOMC rate decision expected to cut rates by at least 25 basis points on Wednesday at the culmination of the 2-day meeting. We've been over, the cut is very much priced in 100%, really pretty much for the 25 basis points. What is the level of risk that you have at the moment on a potential 50 basis points? They've done it before. They did it this time. I think they did it roughly this time last year. So it's not beyond the realms to surprise the markets or to go to the upper end of rate cutting abilities. Mike, what do you reckon?
I would be very surprised if they delivered a 50 basis point cut next week. I think
very surprised or a little surprised?
No, very surprised.
Okay.
And I think the reason for that is twofold. One is that certainly compared to this time last year, the risks to inflation are completely on the other side. Right now, inflation risks are tilted to the upside, whether that be from tariffs or whether that be from something that Ryan and I have discussed quite a lot, which is actually the potential for an economic reacceleration in the US once we've sort of adjusted to all of the trade kind of thing. The second reason is because last September, we did have sources storied in the run. Nick Timiraos, for example, the Wall Street Journal was touting the potential for a 50 basis point hike during the blackout period to kind of lay the groundwork for such a move. That hasn't happened this time around. I think in terms of the risk is really around what happens after September, because you've got money markets right now, as near as makes no difference, fully pricing 3 25 basis point cuts in total. So at each of the September, October and December meetings. And then also pricing rates getting down to about 3% by the end of next year. So, of course, the Fed are going to be giving us their latest SEP, an updated dot plot. If the dot plot only shows 2 rate cuts this year, one of which is going to be delivered at the September meeting, that's obviously more hawkish relative to market expectations. And you could see some downside in treasuries, some upside in the dollar, and a bit of a rolling over in equities as a knee-jerk reaction to that.
But I mean, Powell himself has said in the past that we should ignore is probably the wrong word. We should pay less attention to the dot plots themselves and listen to what the members are saying, I guess. But the markets are, I wouldn't say the markets are forcing their hand at the moment. Trump's forcing his hand at the moment, and very much the data. So, it's a good point. Ryan, anything to add?
Yeah, you can never rule it out. I mean, we're talking about central banks here, and who knows what goes through their mind. I'm the same as Michael, though. I think it's a very low risk that they go a 50, purely because of what that might indicate to the market. Are the Fed panicking about something? Have they been caught with their trousers down again, this time on jobs rather than inflation, and they're playing catch up?
That's what you can argue they're playing catch up, and that they're behind the curve in that respect. So you could justify it like that if you wanted to. You
could do if the rest of the economy was going with it. But this is really, we've had 2 wobbly jobs numbers from the NFP. As we've been talking about, jobless claims hasn't been flagging anything, and I still find that very surprising, which again points to potential, the migrant immigrant factor in the jobs market. But yeah, we've had 2 wobbly jobs market. Powell at Jackson Hole pushed the onus onto the labour market from inflation, but the market has still seen sticky inflation coming out for the last 4 or 5 months. So they could do a 50, but I think if they did a 50, they would. Powell would be very, very quick to say, "Yeah, we're doing a big move now, but now we're on pause. because we are playing a bit of catch up maybe, but this isn't going to be a 50 this month, a 50 the next meeting, and a 50 thereafter. We're not getting into that sort of scenario. But I don't think he will want to panic the market. He's more likely to confirm 3 cuts for the rest of the year, which will do the job.
Yeah.
Keep the market happy, keep Trump, Smalls happy. We'll have 75 pips of cuts by the end of the year, and then maybe looking for a bit more next year. And I think that's the path of least trouble for Powell from this point.
Okay, awesome.
I do think, though, that there will be almost certainly one, if not more than one dissent for a 50 basis point cut, namely Steve Moran, and potentially Bowman and Waller joining him. But I think also maybe the other hawkish risk for markets is if there's a dissent in the other direction. I was looking through some recent comments from FOMC policymakers, and both Musalem and Schmid, who are 2025 voters, now albeit they said they made these remarks before the August jobs report, but both of them were relatively hawkish and didn't seem especially convinced of the idea that any rate cuts were required. So you could end up with a bit of a Bank of England-esque situation where you've got a three-way split among the FOMC, which again the market would probably take hawkishly.
Yeah, very good point there. Okay, I've listed some of the data out. US retail sales next week as well, which would be interesting to see about consumption and the state of the US household consumption, US consumer on that front. I want to turn to the UK. We've got labour data out, inflation reports out, and next week ahead of the Bank of England interest rate announcement. I've got a note here from was it Barclays, if I got it. Decision to hold bank rate at 4% next week is almost inevitable. However, the minutes could still highlight divergent views on the committee and data flows consistent with gradual and careful cuts beyond. We think quantitative tightening will be slowed to 75 to 80 billion sterling per annum, leaving scope to shorten the maturity of sales. That's coming from Barclays. So we'll encompass the Bank of England and also the Labour and CPI reports out this week. Ryan, we'll start with you. Bank of England, what do you completely rule it out? I mean, we saw GDP data out today that was flat on the month, and although now the ONS want us to be looking at the more underlying stable 3-month read, it's still not great at 0.2%. The growth rate the momentum is slowing.
Yeah, I mean, if you're looking at purely at growth alone, you'd be thinking why they're not cutting. But we're not looking at growth alone. We're looking at inflation, which again has been really sticky. It's still not even come down close to target yet, so they've still got that issue, and there's crept higher, and wages have stayed elevated, and that's something that's going to be feeding through over the next couple of months. More public sector wage gains that came through in August, I think. I don't know if they show up this month or next month, but they're in the pipe. Are they going to? They're going to be nowhere near a cut. It's going to be the votes that are important again. And God, if we get another split, I don't know what's going to happen after the fast last meeting. I think we're probably going to get the usual Doves voting for a cut, but I think it's probably going to be more of a 7-2 in favour and holding than anything closer to a cut. I think they've probably got one eye on the budget as well, and what Reeves is going to do later in the year, because that might determine how the market reacts and what happens in yields and what everyone thinks the economy is going to do from that point. So, I think this is a wait and see meeting.
Well, because it's so late in the year, I mean, it's going to leave UK investors just treading water, really, trying to divine where we go fiscally and therefore monetary. What do you think, Michael?
Yeah, I mean, I think the decision on bank rate is very straightforward, unchanged, gradual and careful in the guidance, probably 7-2 with Taylor and Dingra dissenting for a 25 basis point cut. I do think, though, that the decision around quantitative tightening is going to be quite interesting for a number of reasons. Obviously, we've had this big run up in long end gilt yields over the last couple of weeks, we are off the highs by 10, 15 basis points, but the market's still clearly very, very fragile. So I think the BOE for the last 3 years have let the balance sheet roll off by 100 billion a year. The question is, to what extent do they slow that, and also what do they do with their active gilt sales? I would say personally they should probably be ending that completely. There's no real need for it. It doesn't really do anything from a policy perspective. It adds a premium onto the gilt yield, and it actually just crystallizes losses on the bank's holdings. If they don't do that, then as that Barclays note said, at least tilt those sales towards shorter maturities to try and provide a bit more stability at the long end of the gilt curve. The other reason why that's important is, I think, Ryan, you said the bank will be watching Rachel Reeves closely. I think Rachel Reeves will be watching the bank very closely this week, because what the BOE do in terms of their quantitative tightening plans, that will directly impact the degree of fiscal headroom that Reeves does or doesn't have when the OBR put their forecasts together, because, of course, the Treasury have to indemnify the BOE for any losses they're making. So if the BOE were to reduce active sales quite substantially or even end them, then that could actually give Rachel Reeves another 3 or 4 billion back in her back pocket and lead to a little bit, perhaps a less of a painful budget than we're expecting. So I think that's going to be interesting. But for the BOE, it's really, I think, all eyes now on the 22nd of October. That's when we get the September CPI numbers. And if that CPI print is above the BOE's forecast of 4%, then you can kiss goodbye to the chance of another rate cut this year, I think.
I think you're giving Reeves a bit too much credit that she actually knows what QT is in the first place and what headroom it's or not it's going to give her.
Mate, ex-BOE economist, I'm sure she's all over it.
Oh, yeah, sorry, my apologies. Yeah, you're quite correct. I stand corrected.
Here's a little bit of a curveball. Are you surprised at all the reshuffles we've had and all the job changes that the Prime Minister has made that she's still in her position?
I'm not actually.
Snap.
The reason why I'm not is because I know we laugh about it, but the market reaction to her crying in the House of Commons kind of said all you need to know about how the markets would take Reeves being replaced as Chancellor. I don't think anyone's got much faith in what she's doing, but all of the alternatives are about 10 times worse from a market stability perspective, I think.
Yeah, fair play. Right, we're coming to the end, so I want to quickly go through the rest. Bank of Canada interest rate announcement. Obviously, it's pegged to a degree on what it sees across the border with its neighbour. I've got a quick TD Securities preview here for them. We look for the Bank of Canada to cut by 25 basis points in September as the economic outlook has deteriorated further, while core inflation metrics are beginning to decelerate. Markets are well positioned for the bank to cut, but the path of least resistance is still towards a steeper curve. And this TD Securities maintains its bias for Canada to underperform versus the US in tens and longs. And for the loonie, they expect the CAD to underperform peers in any dollar sell-off as the overhang of BOC cuts, the pending trade deal, and the USMCA renegotiations prevent investors from turning bullish. I know you guys look at more long-term than this short-term move. So do you have any thoughts on the loonie, Ryan, quickly on that?
Yeah, I think expectations for a cut is probably about right. If you want to see a jobs market that is really, turning sour, then the Canadian market is one to look at. Their unemployment was, I think, 7.1 at the last look. So that's been moving the wrong way. As far as the loonie is concerned, it's always caught in the crosswinds between the dollar, the US dollar, and the Canadian dollar. Dollar CAD has been one of the pairs, even considering the recent sell-off that we've seen over data and stuff, that's held up pretty well. So I think once the market knows what it's doing with the Fed, and if, let's say, we've had a sell-off in dollar CAD on that, then I think there's likely to be further upside for dollar CAD as it switches out of that towards what Canada's doing. But double trouble for them on Wednesday. Obviously, we get the Bank of Canada first, so could be a bit of a mover.
Well, a lot of that Canadian job data was overshadowed, obviously, because of what we saw in the US, I guess, last week. Right, very quickly, then, JP, your Japan CPI obviously key with the Bank of Japan rate decision. We're not expecting the Bank of Japan to go in September. We are looking for them to go before year end. Any views on that, Michael, in terms of do they procrastinate? Do the elections or the leadership change play any part in what the Bank of Japan is likely to do?
Well, they'll definitely procrastinate. I think that's one of the things the Bank of Japan are best at, is dragging their feet and procrastinating
mandate,
things.
isn't it?
There's always an excuse for them not to tighten policy or not to do anything. Earlier in the year it was trade, then it was politics, then now it's politics again. I think some of the sources stories we had earlier in the week were interesting, though. I mean, we're not expecting the BOJ to do anything this time around, but those sources stories were all nodding towards the likelihood that the BOJ, at least see a hike as possible before the end of the year. They're not going to let this political uncertainty completely keep them on the sidelines, but at the same time, they're going to be very, very non-committal. And I think it's just going to be a repeat of what they've said before, where they will raise rates if the outlook evolves in line with their expectations. But to say they're in no rush to do that is probably an understatement.
Ryan?
Yeah, I can agree with that. I mean, in our neck of the woods here at Fortis Analytics, we've been thinking that the bank have moved that much closer to being able to hike again. The data's holding up, inflation data's holding up. There's going to be the odd gyration here and there, but they've been closer to a hike than they've been since the last hike. Next week we're going to have to. I think the rumours we got on the sources pieces were Bloomberg, so obviously take those with a pinch of salt. We're probably going to get Japanese press, Gigi and the like, maybe dropping some pieces, but I think we can't rule out a hike by the end of the year. But then this is the Bank of Japan. It's not going to mean they're going to enter a rate hike cycle where rates are going to be up 200 pips by the middle of next year. So we might get one and then they'll be done for another 6 months. So anyone looking for a massive gain in the yen on a BOJ hike might be a little bit disappointed.
Yep, good points. Thank you very much, guys, for your participation today. The Saint agrees with the financial markets world.
They're back.
there you are.
Who's who?
Anyone who wants.
I'm the one with that hair, of course.
It does you credit, sir. That's all I'll say. Guys, I'll put up the links to where we can find you both. You've got Ryan, who's from Forex Analytics, and our guest Michael Brown there of Pepperstone Brokers. So we'll put your links up where you can find a bit more on what they do and what they say about the markets. But thank you guys for this. It was very much appreciated and another very insightful episode. So cheers.
Always a pleasure, mate. Thank you.
And happy Friday.
Yeah, good weekend.
Indeed.
You guys too. Have a good one. And we'll see and hear from you guys again in the near future. And anyone who wants to listen back on this, you can listen back on any of the podcast platforms, and it'll be on YouTube, X, and Facebook. So thank you for listening.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.